All right. So one of the philosophies at Easy Office is we want people to not only be able to fulfill their missions and run the causes of their nonprofit, but we really also want them to be able to use and know and understand their financial statements. Nonprofit accounting for our accounting for nonprofits can be really confusing. It can be it's actually much more complex than for-profit accounting. And our goal is not in this session is not to teach you how to create the information, but our goal is to teach you how to use the information. And we think that any executive director, program manager, or staff member at a nonprofit really needs to have a solid understanding of the financial statements and what exactly they mean. So real quick, 2 minutes on this, who we are. Our goal in life is to improve the effectiveness and efficiency of nonprofit organizations. We have 2 slogans that we throw around. One is do what you do best. The other is, we are your accounting department and we work to make sure you're audit ready. So one of our philosophies, again, is that we want to keep everybody's books in an audit ready shape so that any month the auditors could roll in and you'd be set. We're a social venture. We work expressly with nonprofits. We were founded about 4 years ago by a team of Yale MBAs and CPAs who said there's got to be a better way to help the nonprofit sector understand and manage their finances. I'm Jeff Russell. I was a former executive director, so I know what it's like to wrestle with limited budgets and big dreams and big aspirations. I also spent some time as a consultant at Accenture before we started Easy Office. We actually have now about 165 clients spread out across the United States, and we have about 40 accounting staff. So those numbers are out of date by 3 or 4 months. So we're growing quickly. A lot of nonprofits are trusting us with their finances, and we're excited to help them. So why do we care? Again, real quick summary on why we care about the nonprofit sector. One of the main reasons is there's significant room for improvement in the sector. A study by Indiana University's nonprofit overhead cost found that over 50% of nonprofits generally do not follow GAAP, and GAAP is the accounting rules for the nonprofit industry. 20% report implausible numbers, such as a negative number or something that's just, it would be impossible for that number to be accurate. Another 25 to 50%, and this is a really important one, end up reporting numbers that make the nonprofit look worse than if they had actually followed GAAP. This is really true with organizations who don't have the expertise. They're presenting numbers, presenting things that don't portray the organization in the proper light. Maybe they show them spending more on admin than they really are, or maybe they show them not spending as much as they really are. So these are important reasons and why we really want to help the sector improve. And lastly, only 16% filed their 990s correctly, and so that's a really low number and gives us significant room for improvement. The other issue is as a former executive director, I know it is extremely rare that few CPAs become executive directors and few executive directors are CPAs. That's a rare mix. Most executive directors, my wife's now an executive director, she wears a lot of different hats, right? And you're pulled in a lot of different directions. You're raising funds, you're managing staff, you're engaging your clients, you're engaging the people that you're working with. And it is tough to find all of those skills and someone who can also do all of these things. It's a really challenging position. The second reason we really care about nonprofits is that small organizations in general are disproportionately impacted by fraud. And organizations with a Harvard study showed that organizations with less than 100 employees, they had average about 100 grand in fraud. When there was fraud, it was about 100 grand. And for organizations that had over 100 employees, the average fraud size was the same. It was right around 100 grand. And so most, 90% of nonprofits are less than $1 million. 90% of nonprofits, probably 95% of nonprofits are going to have less than 100 employees, but there's still the risk for significant fraud. And so having good internal controls and financial statements is one of those types of controls. So how do we do it? How we think about it is build, run, report. If you've built your initial infrastructure correctly and then you run it consistently, the reporting and everything should fall out of the system for you. And so today's session is really focused on the reporting piece. We've got 2 other webinars that are on our blog at youreasyoffice.com. They really go into the build piece and the run piece a lot more. But today we're going to talk about the reporting piece. The thing I always say here is if you're struggling with your reporting, you're spending a bunch of time in Excel, manipulating data, moving stuff around, that means there's a fundamental problem either in how your system is built or in the daily, monthly, weekly booking and how you're running it. There's really 3 pieces that you have to keep in line with your financial systems. And again, the other sessions go into this more. You have people, you have processes, and you have technology, right? So whoever is doing your books, you both have maybe a CPA firm who's overseeing it, either on an annual basis, maybe some do it on a monthly basis. And then you usually have some combination of volunteers or in-house staff or someone like EasyOffice that's working, that's actually doing your stuff. Your processes need to match who the people are. They really should be consistent. One of the things to highlight is make sure they involve appropriate checks and balances. With smaller organizations, this is tough, right, because you just don't have enough people to divide up all the work. So that's where a third-party firm can help out, or a very reliable volunteer or something like that. And then the technology piece, this is a more complicated question for another day. 90% of small nonprofits use QuickBooks. Quick note on that. The issue with QuickBooks is we hear disaster stories of, it basically gives you enough rope to hang yourself. And so it's a very, very flexible system. It's very easy to use, but it definitely requires some process discipline if you're tracking grants or allocating your funds across all your different programs. There's a lot of technology out there, but QuickBooks is by far the most prevalent. This is a quick overview too, because this is sort of a fundamental building block to how the reports show up for you. If you see on the right there's the donor, there's the expense, there's the year, and there's the program. And so really any transaction that comes in can be tagged to a donor, it can be tagged to a program, it can be tagged to a date, it can be different years. So one transaction may have 5 or 6 different attributes to it, right? So when you go and you pay a bill, and say you're paying, a vendor came in and did a workshop for you, and you're paying for that workshop. It could have been a donor could have funded that workshop for you. So you need to track it back to the donor and say, here's what we spent your money on. Maybe you want to track all of your Saturday afternoon workshops for the after-school program. That's a program, right? So all the transactions need to roll up into that. And then you also need to know all that you spent on certain vendors. So there's a lot of different attributes. It's sort of like a Rubik's Cube, and you need to be able, one thing needs to be able to have all these different attributes at once. So when you have, and again, like I said, if you're wrestling with the reporting, it's maybe because this fundamental structure is not set up correctly. Okay, so that is the overview. Now we'll get to what the main point of the session was, which was how can I make sense of and understand these reports that my accountant has given me, or these reports that the CFO has given me. How do we make sense of them? So we're going to run through a bunch of examples. We're going to kind of talk about what to look for. This is part art and part science. It takes some, repetition and practice, like most things in life. It can be uncomfortable for people who don't understand numbers, or it can be an intimidating topic. The goal here is just to, hey, let's roll up our sleeves, let's try to make some sense of it. And this really is a habit that we like people to be in on a monthly basis, saying let's wrestle with these numbers each month, and we're going to keep getting more and more comfortable with them the more often that we look at them. It takes 30, 45 minutes a month. If you really sit and wrestle with the numbers, you'll have a much better understanding of your organization and what you're doing. So one of the keys, as I've said several times, is reliable financial data. Reliability is also based on time, right? So if you run your reports on a regular schedule, so we like to have, reports out to our clients each month showing them exactly what happened the past month. And that discipline of looking at them every month really helps you understand them. So it's kind of my first tip, because there's no magic formula here other than just make sure you're looking at it on a regular basis. Again, accuracy is important. Your reports are only as good as your bookkeeping. So if you have garbage coming into the system, you're going to have garbage coming out of the system. And it's a very frequent concern when we hear people wrestling with all of their reports once they're in Excel. And our philosophy is you should really be able to run your reports at a push of a button, and that's upstream. You really got to make sure your bookkeeping is accurate. So we believe internal reporting, no matter how small you are, if you're under, say, $50,000 annual budget, then maybe you should do it on a quarterly basis. But everyone else, we think at a minimum, you should be doing this reports on a monthly basis. And what that does a couple of things. One is, if there are bookkeeping errors and you're looking at it on a monthly basis, it helps you catch them and find them. If you're looking at reports in April and it's some transaction from last December, no one remembers what that was. It was like, what did we go to Target for? I don't know what that $400 at Target was for. But if it's April 15th and it was a March 22nd transaction, then people can remember and you can correct it. The other thing is really knowing and understanding and using your reports helps you manage and helps you make better decisions. There are a lot of our clients want board reports completed on a monthly basis, and that's fine. If you've got that engaged of a board, that's fantastic. We think at a minimum it should be done on a quarterly basis. Generally, this will be higher level reporting that you give them, maybe a couple of page summary, but you, the executive director, or you, the CFO, you have all the supporting detail. So if they want to dive into questions, they can go there. One of the issues we see with people sometimes is they give too much detail to the board, and then the board starts obsessing over, well, why do we spend this much money on office supplies? And our solution to that is just saying, hey, you guys need to be focused on the macro picture, the larger picture. We're going to show you the larger summary numbers, and if we need to dig into something, we're going to make you that one step harder, and we're going to make you have to ask, right? So that helps the board focus on what the board should be focused on. There's two types of ways. This is sort of I'll revert quickly to an accounting 101. There's cash accounting and there's accrual accounting. So cash accounting is exactly what it sounds like. You don't book an income or expense until cash moves. So either you pay somebody with actual money, or a check goes out the door and it's cashed at the bank, it's deposited. So it's not counted until things are paid. The difference is in accrual accounting, the income and expense are sort of lined up with the timing of when those things happened. So for example, income, when someone makes a pledge, they may not hand you $1,000, but they'll say, I'm going to give you $1,000. There's rules for how you count that income at that time, but there's no cash has actually been received yet. Accounts receivable, accounts payable, those are philosophies of accrual accounting. The nonprofits should be following accrual accounting. We use what we call modified accrual accounting, so that on a monthly basis, there's a trade-off between the amount of bookkeeping and having perfect accrual accounting. On a quarterly basis, annual basis, we're finding things that are prepaid or pledges, that sort of thing. But anyway, so as a nonprofit, if you're on cash accounting, that should be a red flag to you, to your board, and that's something that you would want to transition away from. So the way accounting works is everything is connected, right? My analogy is a little bit like a balloon. So if you squeeze on one side of the balloon, there's an equal and opposite reaction, somewhere else on the balloon. And so all of these financial statements Once you start to see how they click together and how they fit together, and if you change the income number, how that flows through to your other reports, that's when you sort of have arrived at a really good understanding of your finances. So the top one there is the statement of financial position. In the for-profit world, that's called a balance sheet. It basically is a snapshot and tells you where you're at. And then you have a statement of activities. In the for-profit world, would be a profit and loss statement or income statement. And then you have these budget versus actual and statement of functional expenses, which is, these are all nonprofit specific terms. So quick note on this, if these terms are unfamiliar to you, they're probably going to be even more unfamiliar to your board. And so it's important to sort of translate for them. A lot of them maybe are coming out of a bank or a corporate setting, and you say statement of financial position, and although that's the accurate nonprofit term, they're going to say, well, where's the balance sheet, right? So it's important to kind of help these guys and translate for them. So let's go into each report, and we've got examples here in a second. Statement of activities. So this is, like I said, it's your profit and loss. You have revenues and you have expenses. One of the things that we encourage when you're analyzing your financial statements, from your revenue, one of the things that, funders harp on and what will help your nonprofit be more sustainable is if you have diversified revenue. So one of the things you really want to look at is say, where is all my money coming from? And let's look at each different stream of total revenue. So my wife's nonprofit, they serve refugees. And so she gets some money, federal government, to subsidize the training. She gets individual donations that subsidize the training. And then she has some products that they actually sell at local markets and so forth. And that money goes to help subsidize, help pay for the training. So she's got these 3 different income streams that are all going towards the ultimate goal of training refugees. But if any of those 3 sort of get out of whack, if she's over-reliant on government funding or overly reliant on individual donations, and we say have a recession, then those things can become difficult. So that's one of the key things we like for people to look at. Same thing on expenses. 75% of nonprofits' expenses go to payroll. So really understanding your payroll is one of the absolute most important things to do. And then there's all these other streams of expenses, right? So what are we spending on our after-school program? What are we spending on our bus program? What are we spending on our healthy lunch program? Each of those different streams, you want to be able to understand those, and you want your reports to be able to show you those things very simply. So change in net assets. This is in the for-profit world, at a corporate world, people say this is, are we profitable? In the nonprofit world, there's different debates about whether that's a good term or not. But basically, if you have a positive, if you are profitable, it means you're sustainable and your operations can continue. My philosophy is that profit is sort of like oxygen. You need it to survive, but having a whole bunch extra doesn't really help. But if it goes away, you're in trouble. And so you want to make sure that you're having that as a sustainable organization. And then the savings indicator here, we've got these little indicators kind of throughout the presentation. Revenue minus expenses divided by total expenses. So that's just saying, are you adding money into your bank account, or are you taking money out of your bank account, right? So is the value of the organization growing, or are you going down? A rule of thumb for nonprofits is you want 3 to 6 months of unrestricted cash in the bank. And for some people, I know they've got two weeks of cash in the bank. And so this is something to say, hey, as a board, as a group, by the end of this year, we want to get to 3 months cash in the bank. And by the end of 2015, we want to get to 6 months cash in the bank. And so it can be a stretch goal for people, but you want to get out of the habit of kind of spending hand to mouth with your organization. That's going to help you be a much more sustainable organization. So here's an example. You can see here the revenue from individuals and then from special events. And then they've got their expenses. Again, contract services, non-personnel, facilities and equipment, travel and meetings, and other expenses. So again, contract services, that's typically people, so that's not an unusual number there at all. You know, the non-personnel expenses, if I was a board member, I'd say, you know, can you give me a little more transparency on that? What does that mean? Let's dig into that a little bit. And then on the top side, from revenue side, if I'm looking at that, I go, well, you know, it's pretty diversified. It's split 50-50. You know, the special events income, so maybe that, you know, you have 2 galas a year. You're obviously very heavily reliant upon those events. So if something happens, or, you know, then you could sit there and go, well, maybe we should do a 3rd event, or maybe we should cut back to 1 event, or is there other funding because we're not getting any grants. Maybe we're philosophically opposed to grants. But there's some ways, you know, it creates conversations around the larger strategic picture, and it helps you know where you're at. And then you can see this organization down here where it says change in net assets. You can see that means that they're, you know, sustainable with their current spending. Another thing you want to do is look at this year versus year. This is a pretty standard report. So this is 2009 versus 2008. And you can see that their revenue went down and their expenses went up, right? So that's not a great trend, but it's probably explainable. The changes are not, you know, it's about a 10% change on revenue, so that, you know, that's something to pay attention to. The expenses are basically a wash, but you know, they lost 25 grand for in between the two. So that's just a trend that they would want to be careful about and watch. We see organizations all the time. It is much easier, this is just a general rule of life, but it's much easier to spend more than it is to make more. And it's much easier to increase your expenses than it is to increase your income. And so it's just having this year-over-year picture is a really important picture for organizations. Budget versus actual. If you do not have a budget, I highly encourage you to put together a budget. One is a budget does not have to be, you know, the goal is not that what happens perfectly matches your budget. The goal is that your budget allows you to make trade-offs and allows you to direct the activities of the organizations. It also helps you manage the quality. So if you see major discrepancies between what you budgeted and say you budgeted for a category, and 3 months in there's been 0 spending in that category, perhaps that's a bookkeeping mistake and people aren't, you know, putting it into the correct account. Or perhaps you as an organization decided, yeah, we're not going to do that program, or we're not going to hire that position, which is fine. You know, the budget is a tool. The budget doesn't own you, but it helps you know the trade-offs on those decisions that you make. Or if you've budgeted to make $50,000 a month and you're only making $40,000 a month, then you know you need to go and make a corresponding change in your expenses. So again, same organization. We can look at their budget versus actuals. And so you can see here in their budget, they were planning on about $20,000 coming in through grants. But in actuality, those did not come in. They made up for it because their special events income was higher than their budget. So if you just looked at the big numbers, you say, great, we're right on target. But you want to kind of dig into that and say, okay, well, did we apply for grants? Did we not get grants? Why didn't that happen? And then you see on the expense side, they actually have a pretty remarkably accurate budget there. Here's another one. It's an example where you have a grant. I know with a lot of, you can see up here at the top it says donor, federal government. There's a lot of grants where they'll say, you know, we'll give you $75,000, report back to us exactly how you spent that $75,000. The other way is they'll say, we'll give you $75,000, which is called a reimbursable grant. We'll give you $75,000 once you've spent it. So save all your receipts, and then we'll reimburse you. So in this example, you can see the excess column showing sort of the money that they have left on a grant. So again, this type of report, even out of QuickBooks, you should be able to run at a push of a button. Here's the same thing, just with a different format, where it kind of shows the actual what's been spent, what was actually budgeted for this grant. And so a lot of donors and particularly government grants require this level of reporting. Statement of functional expenses. This is a really important thing. In our sector, for better or worse, people pay attention to the program versus admin ratio. So people want to know, how much of my money is going towards programs, and how much of my money is going towards overhead. And there's a continual debate in the nonprofit sector how much overhead is appropriate. You don't want to starve your organization. We all know that you require boards and accounting and office space and things. You all require administration, and it takes money to make money around fundraising. But what is the healthy balance? The average across all nonprofits is about 75% on programs. And some of the largest sort of, quote, best in breed are going to be more like 10 to 15%. So I think as an organization, if you're under 10 million and you're anywhere between 15 and 25%, that's a very healthy place to be. And I think most funders would agree with what I just said. So here's a chart that shows this across different types of organizations. So at the top, you can see human services. They're at 20%. Arts and culture organizations tend to have a little bit higher overhead. But you can see that's where the data is pulled from. And I think this is 2009 data, again, from the Center for Nonprofits out of Indiana University. They've got a lot of great research on this kind of stuff. The other one is how much money does it take you to make a dollar? So what are you spending on fundraising to raise a dollar? Education is the highest, and then you have health and environment, human services. So for every 17 cents I invest in fundraising expenses, I raise a dollar. So this is another key ratio that a board can look at and say, hey, are we in line with national standards, and are we being disciplined with the money we've been given? So to get to all this research and everything, again, it comes back to having really good bookkeeping. So how you allocate the expenses, right? So someone goes to Target and they spend $400. Is that expense a program expense? Is that an administrative expense, or was that a fundraising expense? The accounting rule on this, the IRS rule on this, is your methodology and how you allocate expenses must be documented, reasonable, and consistent. It does not get much more specific than that. There are some specific rules around newsletters and what can be counted as fundraising versus admin. And a CPA, or we've got a couple of white papers on that we can share. But there is some things that there are very strict rules on. But the most, it just needs to be reasonable. Again, your biggest expense is going to be your payroll. So you really want to make sure that you've got accurate allocation methodology for your employees and for their payroll. That methodology that you pick needs to be approved by your executive director and your auditor. If you are too small to have an auditor, have your board approve it, because someday you may be big enough to have an auditor. The other thing is you can allocate. You can allocate a lot of things, right? So a lot of people think, well, my office space that's just 100% admin. Well, not necessarily. If you've got 10 staff and 6 of your staff are program staff and they're working out of those offices and they're developing the programs and they're counseling people there, well, then that part of that rent can become a program expense. There are certain things, again, that have to go into admin, such as accounting, such as board meetings. Those things have to go into admin. But there's a lot more gray area where if you have a documented and reasonable policy, you can have expenses accurately reflected in your programs. And this is, to go back to one of the early things, that the nonprofit sector in general does not, they tend to underrepresent their program spending, which is not great for us, right? We want to show the world how much we are spending, and so having a good policy and having good documented and reasonable methodology really helps you portray yourself better to the outside world. So here's an example of an organization. They're at 70% programs. Part of that is they're a smaller organization. They're $200,000, and this organization in particular I know was in a growth phase. So they made an intentional decision to invest a bit more in their administration and their fundraising as they grew out of that. This organization, just on that point now, in 2012, I think has a $1.5 or $1.6 million budget. So they've grown a lot. So when you look at this, you say, okay, their admin fundraising adds up to 30%. Is there things we can do here to improve that? All right, so that was Statement of Financial Activities. Let's talk about the Statement of Financial Position. Again, this is what is commonly referred to as the balance sheet. So the thing with the balance sheet is it is giving you a picture at a point in time. It is someone comes into your organization with a camera and does a snapshot and says, this is where they are exactly right now. Your Statement of Financial Activities, your profit and loss, it's reflecting the activities over the entire year, right? So it's adding up all your expenses, it's adding up all your revenue, and it's saying, here's where you are for the year. Whereas a financial position or a balance sheet, again, it's a very specific time. There's three main portions to it. There's your assets, which is what you own. It's your cash. It's land, property. Your liabilities. So if you have a loan, if you owe people money for payroll, and then your net assets in the other world is called equity, but it's sort of what's left over. And so when you see that formula at the bottom, the reason it's called a balance sheet is because the assets have to balance or equal with the liabilities and net assets. So that's, again, back to the original balloon analogy. If I decrease my assets, I've got to either decrease my liabilities or decrease my net assets so that everything stays in balance. So that's where that term comes from. Here's just, again, examples of types of assets and types of liabilities. One of the things, every industry has jargon, right? So my brother works in the healthcare field, and the jargon that is normal to nurses and doctors is not normal maybe to the rest of us. And it's the same way with accounting. So when people who are in the numbers and in accounting, they know assets and liabilities, all these things intuitively make sense to them. And back to one of the earlier points I made is that if you're looking at this on a monthly basis, all these terms will slowly become less intimidating. You'll slowly get more comfortable with the terms, and you'll slowly feel better, with the jargon. And that just takes time. There's just no way around that. It takes the monthly discipline of looking at it to really feel comfortable. Net assets, one of the things I'll point out here, there are three types of net assets. There's unrestricted, which is what everybody loves. You want to have unrestricted net assets. That's what you can spend on whatever you want to spend on. There's temporarily restricted, and so that is a donor says, you are only allowed to use this for the Saturday afternoon program, right? So that money becomes restricted. So it can be temporarily restricted either based on purpose or time. That's temporary because when the time comes, it becomes unrestricted, or when you use it on a specific purpose, it becomes unrestricted. The last one, called permanently restricted, is for endowments. And so for those of you fortunate enough to have an endowment, you know what permanently restricted funds are. If you don't have an endowment, you don't have to worry with permanently restricted funds. So the next thing is grant tracking. We've talked a little bit on this. There are two types of grants, basically, when you boil it down. There's ones where the revenue comes in first. So somebody gives you money and says, use this on this purpose. And there's the others, which are reimbursable grants, which means you have to incur the expenses first and then pay somebody back. And again, you want to be able, in your financial reporting, you want to be able to really see these things across the board. So I'm going to go into a couple of key metrics here. Just a time check. We're coming up on the end of the hour. I apologize for the late start, again, with the technical difficulties. I am going to just go ahead and continue through the rest of the presentation. I assume it'll take me 10, 15 minutes. So if you have to jump off, know that this is being recorded, and we'll put it on our webinar if you want to catch the last 15 minutes of it. But if you can join for another 10, 15 minutes, that would be great. So here are some ratios. This is sort of, we just went through, say, the 101 portion. This portion I'm going to say is the senior level 401 class, in that, you know, these are fairly sophisticated metrics that a sophisticated board is going to want to look at. If you've got people from Wall Street on your board, then these metrics are going to, you know, they're going to take notice of these. But, you know, for the vast majority of organizations, you know, these are, if you've done everything we've said to this point, you're going to be great. But here is sort of some more things you can do to really dig deeper into your finances if you want. So one is what's called a defensive interval. It's more commonly, you know, months cash on hand, how much, you know, how liquid are we as an organization. So this is really, the reason it's called defensive is if donations just went away today, they just disappeared, how long could you keep operating? And so this is really just months cash on hand, and that's a formula for it. The second one is a debt ratio. You know, not a lot of smaller nonprofits have debt. People tend not to get loans, but if you do have a lot of loans, you want to look at your ability to pay those off. So this is your debt ratio. What's your total liabilities to your total assets? So the lower that number, the better. Accounts payable aging indicator. So how quickly or how slowly are you paying your bills? For organizations, they may look at your accounts payable across time, and if they see that you're taking longer to pay your bills, that can be a red flag and saying, oh, this organization may have some financial difficulties because they're, you know, hiding bills in their drawers, or they're not paying their vendors, they're not treating their vendors well. You know, so there's different opinions on that, but it is an indicator that people can look at. A much more important one is this next number, which is what % of your funds are unrestricted. We have worked with clients in the past who have gone bankrupt because they did not have unrestricted funds. So many of their funds were in the restricted pile. They had plenty of cash in the bank, but they legally couldn't use those things for overhead or for other programs that they wanted to do, and you know, they just weren't able to sustain the organization purely just because of the restrictions placed on them. I think that over the past decade, this is something that funders have come to know and appreciate. I think more and more funders are giving unrestricted funds, but I'm guessing, you know, as again I see with a lot of executive directors, there's still a lot of restrictions on the monies that we manage. So here you have an example. The defensive interval, that OPEX means operating expenses. You'll also hear people say CAPEX. That means capital expenditures. But so if you look at this statement of financial position, if you look at their balance sheet, and you do the math on these things, You say, okay, they've got 4 months operating expense cash in the bank. That's pretty good, right? That's fairly conservative. That gives them enough. If there is a downturn or if something weird happens, 4 months gives you enough time to react. If you've got 1 month, something bad happens and boom, you're out of money, right? And so that's why you want to get that number up there. And then I'll skip to the last one, the percentage of funds unrestricted. You can see down here at the bottom, the 25 grand and the 13 grand. That's pretty good. If 2/3 of your assets are unrestricted, that's really nice. Additional reports you can produce on a monthly basis is you can run a report specifically by program. You can run an event if you're big on special events. You can run a report that just shows the activities around that event. The last one that I think is an important one is your donor analysis. You can look at it, income by donor this month, this quarter, this year, to really target who are your repeat donors, who are your big donors, and to go through it that way. I'll close with some comments on presentation. When you are dealing with your board, if you're the executive director, you think and breathe and live the mission of your organization. Your board members may or may not, right? And so the goal is to really, as I kind of said early on, really provide them with an executive summary. And all the addition, some of these standard reports we talked about, they're going to want to see an executive summary, statement of financial position or balance sheet, statement of financial activities or P&L. Like at a minimum, they should be looking at that. You, as the person presenting those information, you need to have a stack of reports with you so when they dig in, you're able to present it. One of the things that I also know boards really, really appreciate is if you send the information to them at least a week prior to their meeting, that shows that you're prepared, it shows that you're executing well, and that you take the finances seriously. If you send it to them the night before or the morning of the meeting, it doesn't instill the same form of confidence. So one of the things we really try to do is we try to get a schedule of our clients' board meetings, and then we sort of back into a plan to make sure that they're getting their reports, significantly in advance of those board meetings, because we know that those are pivotal times for organizations to really look at their finances. A few presentation tips. One is simplicity. The more you can narrow them in on the information you want them to look at, the better. Use graphs and pictures. As much as you can use graphs and pictures, the better. Looking at a bunch of Excel sheets can really get wearisome, even to people who like numbers. And then the last point, again, I've said it a bunch of times, but it's really important to reiterate. Nonprofit accounting is very, very different from for-profit accounting. So you really want to educate your board on these differences and translate for them. The whole idea of restrictions is a foreign concept to a lot of board members. And so to be able to understand, yeah, we've got $200,000 in the bank, but $180,000 of that is restricted for next year's dance recital. So we really only have $20,000 that I can spend today. And that is a tough thing for some board members to kind of wrap their head around. So here's what you would want in your executive summary. The last point, make sure you do have a financial overview, so at least you're showing the kind of the key numbers. Here's our total revenue, here's our total expenses, with notes on, hey, this went up 20% this year, this went down 20%. You want to be able to talk to all those things. Oops, sorry. So here's an example of, you've got a separate, the summary is on the left. It shows $577,000 in revenue from direct contributions. So that's what you present to the board. And then you have a separate report. So when someone says, well, what of that was from individuals? You've got this other report on the right that says, well, it was about half foundations, half board members, but very little outside of that in the grand scheme of things. So, having this extra supporting data really shows that you know and understand what's going on. And here's an example of just, pretty charts that show some of your key ratios. You've got 77% unrestricted funds, that's nice, 75% on programs. Those are key metrics that a board would want to look at. Final thoughts? Strong financial management is essential to the success of any organization, whether they're a for-profit or non-profit, volunteer-run or not. Really knowing and understanding your finances is essential. You want to make sure you engage finance members on your board. For that matter, you want to engage your entire board. And at a minimum, for you yourself, again, our philosophy at Easy Office is we don't think you need to know necessarily how to create the information, but we do think you need to know how to use it and make sense of it. And our goal in life is to help you make better financial decisions because you've got a good understanding, and you've got accurate numbers to make those decisions with. And then back to the build, run, report, that equals financial success. I'm going to skip through this part about Easy Office because we started late. If you do want to learn more, grab us, and you know how to contact us. We'll be happy to talk with you. It's a really flexible solution that we can work with you. We work across a bunch of different technology, and we'd be glad to talk with anybody. Went backwards, sorry. Clients all across the country, all doing pretty amazing work out there in the world. So with that, I am going to open it up for questions. So I'm going to unmute everybody, which will could create a lot of noise because if people are in cars and driving and all that. But I do want to give everybody an opportunity to ask questions if you have any. If there are no questions, we will sign off here in a couple of minutes. And I appreciate you guys' time, and I appreciate your patience in sticking around while we had the technical difficulties up front. Thanks, everybody.